Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, founder and CEO of Shepherd Wealth Management, also certified financial planning professional. Very happy to be back in studios here in Florence. Lots to talk about today.
Tons.
And it's also kicking off March Madness. So just before we get into all the important and very interesting news that we've gotten and reaction in the marketplace this week, we got a little fun as well coming up here. So hopefully everybody gets a chance to fill out their brackets, pick their favorites, and we'll see what happens.
Already filled out more brackets, and I'd like to admit, being a native of Kentucky, this is basically my Easter and Christmas and Ramadan all rolled into one.
Yeah. Exactly. And you got St. Patty's Day coming up tomorrow.
Yeah.
I have kids, so, my St. Patty's Day is like, green milk or something like that.
Oh, that's cool. This is the only contact I have with any Irish culture, period, is just having people tell me it's St. Patrick's.
So the red hair is just for fun?
Yeah. Well, thank you for bringing that up. For those of you that can't see, I am what's known as ginger.
Well, my wife is too, but it's more fake. You just can't tell, though.
Yeah. Now, unfortunately, this is very real.
Well, we love it. I love it. I love doing this show. And just for, in all seriousness, we got a lot of really important things to talk about today. And usually when days like this happen, I just tell, as my everything related to technology kind of guy, say, turn on the lights, turn on the camera, and let's just roll. I got stuff to get off my chest here. And it's kind of that day. But this is very serious stuff, too. So I want to have the right tone to this.
Okay.
But we're going to have a little bit of fun as well. So for those that might be watching the show for the first time, we wanted to do this on YouTube Live. We planned on doing that about 10 o'clock this morning. A little bit of audio issues there, but we got that figured out. So we're starting a little bit later. But the whole point of doing this show is you all can watch the news and see exactly what's going on right in the moment. We have it on here in the office right now. And I have it on all the time, pretty much all day long, 24 hours a day, 7 days a week. I got something in the background, whether it's CNBC, Fox News, etc. And the news does a really good job of telling you what's going on right now, what is the headline, either positive news or, in most oftentimes, especially right now, it's all the bad stuff, the headline news. And they're doing their job. Their job is to placate to people's emotions. And we are hardwired as human beings with fear and greed. And the news does a really good job of playing into that. However, I think the news does a poor job of providing historical precedents because there's usually is not the first time that this particular headline news thing has happened in the past. And we try to provide the historical precedent as well as telling you what's going on and why. That way you can now formulate a game plan for going forward based on what history has to say about similar events.
Yeah, 100%. I mean, there's a difference between acknowledging what's actually going on with the situation versus fear-mongering to get views.
And that is exactly what's going on here today. And that's why this is so important. Right now, all the trading activity we've gotten so far this week has been 100% fear-based. I'm about to prove that to you, so welcome to my show.
Yes.
Start out with the good news, other than the fact that, we're coming into March Madness here, and we got St. Patty's Day tomorrow. So let's talk about inflation. So we did get some inflation reports. I don't know if people remember this or not. It came out on, this week on Tuesday, and then yesterday. You wouldn't know this because of all the bank news that I'm about to get into here in just a little bit, but I'm going to start out with the good stuff.
Yeah.
All right.
Okay.
So Tuesday, everybody was freaked out based on the bank failure, Silicon Valley Bank, the Friday previous. It all got resolved during the weekend. Jerome Powell and Janet Yellen basically came in and figured out a way to provide some stability to the financial system over that weekend. So that was still everything that everybody wanted to talk about on Monday. March 13th, but on Tuesday, March 14th, 8:30 in the morning, we got the CPI data, and it came right in line with expectations. So still coming down, still didn't come down as fast as prior months, but still coming down in the right direction, so that's great. And we backed that up on Wednesday, March 15th, yesterday, with the producer price index. So this is what, companies pay for creating things, right? And that came in negative. So that came in way below what analysts and economists had expected. And if you start to strip out things like housing from the CPI index, you're basically running a 2% inflation rate, which is the Fed's long-term target. I'm going to talk more about that here in just a second. So that was excellent news. What should have happened? Well, Tuesday, we actually had a decent day, right? The indices were up pretty substantially. Actually came back down a little bit at the end of the day, but they were still pretty solidly. It wasn't the type of rally that I was really hoping for based on that kind of CPI print. But again, I would have hoped for a little bit of a lower number. I think we're really getting ready to see that in the coming quarters here. I'm going to talk about that a lot here in just a little bit. But when we got that producer price index number coming in negative, when analysts were expecting a slightly positive number, we should have had yesterday nothing but an up and to the right hockey stick kind of move for every major average, specifically technology, would have been just a rip-roaring kind of day. But then we also had to deal with this additional banking news coming from Credit Suisse, this little bank that I'm going to spend some time talking about here in just a little bit. But in spite of all of that, the 2-year Treasury note, which we've pointed out I don't know how many times in previous podcasts, that it's a really good leading indicator as to where the market believes interest rates are going, as well as what inflation is going to look like. Okay. Now, coming into this year, the 2-year was hanging out, below 4% or right around that 4% number. Then we go and get into February. We get the January, jobs information as well as inflation information. Everything was cool. Tight labor market still exists today as it did back then when we got that information in February. But inflation was down. It was just, not down nearly as much as prior readings. So February from a market performance standpoint was awful. Completely terrible. And then everybody was talking about the Fed taking interest rates to 6+%. Like that was the conversation 2 weeks ago, right? Before all this banking stuff happened. Yeah. The 2-year climbed to nearly over 5%, like within days. Now we're back under 4%. The 10-year Treasury also under 3.5%, which is a huge number. That was obviously much more elevated just a few weeks ago. So the narrative of inflation risk coming into this year was, hey, man, inflation's rolling over. Everybody's getting ready for this awesome year. January was just freaking amazing, specifically for technology. The index was up like 15%. It was popping. Then we get a little bit of news, like I said, in February, and that gets thrown out the window. Now it's like, hey, man, we got to go to 6% or higher with the Fed raising rates. Otherwise, we're just going to be in 1980 purgatory from now on with inflation being, near double digits. Yeah. Right? And it shifted again in just a couple of days. And again, the numbers are showing it, the 2-year, the 10-year, I just talked about it. So hence the podcast today. So you can kind of see, this gets me a little excited because it affects my clients. It affects my business, obviously my family. But the truth of the matter is there's a lot of people out there in the marketplace, not just here in this country, but around the world, that just don't simply know what to do because they also have jobs, families, health issues or whatever it is going on in their life. Now they have to worry about all this other stuff, and it's flip-flopping between interest rates and inflation. What's the real fear now? Is it 2008 all over again? This is the reason why we do this show. I'm about to tell you what I think in live time. I have like 4 bullet points here, by the way. These aren't like detailed notes. Okay, I got all this research on my computer here. Yeah. But I've had days to stew on this.
Well, it's also your job.
It is my job. I do have time to spend.
Certified financial planner.
Professional.
Trademark.
That's right.
Financial professional, excuse me.
That's right. Registered.
Yeah.
That's right.
I'm so upset by this news that I flip-flopped the P's. So maybe just let you take it back over.
All right. So let's start with start from the top here. I'm going to work my way from Friday to today.
All right, let's do it.
Let's do this. So you got to keep me on time here, Ez, because since we're doing this live now, I have no real idea.
Yeah. Well, we have always had a live show, but this new format doesn't cause us to, we don't have to take mandatory breaks.
True.
That's kind of the point why we made over here. So you just keep going.
All right, man. So I don't want to do the Joe Rogan 3-hour thing, but we'll try to keep it reasonable here. So
I'm not scared, Joe Rogan.
Silicon Valley Bank, obviously in California, Silicon Valley, where all the tech startups basically begin their careers from. And this bank had an awesome niche for decades. They were basically the primary lender to up-and-coming startup technology companies. They created all kinds of billionaires. The list is exhaustive. You can Google it. There's a lot of really smart people with a lot of money in that bank. And that bank was lending to these small businesses. And obviously, as a tech startup, if you were to ask any venture capitalist company, typically, so we talk about long time horizons, like looking forward over a long period of time is a good idea if you're going to be investing in the market, because the market's a terrible place to get rich. It's a great place to build wealth over time, right? So if you look at a venture capitalist company and they're making, big investments over many, many years into these tech startups, as an example, and they have at least a 10-year horizon as they begin to make these investments, because they understand there's going to be a big burn rate for cash.
Yeah.
I mean, you could just look at Tesla in its early days as a great example of that. Now, just break that down into much smaller tech companies too, because that's also who they're lending to. So if you're running this bank, Silicon Valley Bank, and you're in the right spot, you're in the perfect spot for tech startups, right? And you're the go-to bank that everybody wants to get a loan from because that's your niche.
Yeah.
Right. If you look at JP Morgan, Citi, US Bank, they don't have one niche. They're lending to everybody in all kinds of different industries across the country. That in and of itself is what diversification is all about.
Yeah.
Silicon Valley was really just lending to people in Silicon Valley, and almost 50% of their loans went to tech companies, most of them startups. All right. So there's the backdrop. Everything's cool when interest rates are zero.
Right.
It doesn't cost the bank any money, hardly at all, to go borrow it from the Federal Reserve or whoever they need to get access to, let's say if they needed deposits. But when rates are zero and they can lend it out to these tech startups at, let's say, 1%, bank makes the spread, right? Maybe they loaned it out at 1.5%, I'm not sure. But that's probably something in that window. It's certainly 3 or less, right? That's a pretty good deal for the bank. Paying nothing really to the Fed Reserve. I get to lend it out to you for 3%, let's say. Whatever the rate is, I make the spread. It's called net interest income. That's how banks make money, right? Now, that's great when you cash flush with deposits.
Okay.
All right. Now, all these banks, 2020, 21, cash flush, right? Rates of zero. February of 21 says to the whole world, we think we need to increase interest rates by 1% going into 2022. Okay. So rates are finally going to go up, but not dramatically based on what they projected in December of 2021. So if you're running the bank, if you're the CEO of Silicon Valley Bank and you're cash flush for decades because of the way that rates were at zero, then all of a sudden you got to figure out what you're going to do with all this cash, right? Because if you can't lend it out fast enough and you have way more than you need in reserves, well, the bank has to put that money somewhere, right? This is leading up to 2022.
Yeah.
So what's the bank going to do with all these deposits that they got? They lent it out as fast as they could to these tech startups, and they just continue to have way more cash than they need to have in reserves, so it has to go into their investment portfolio. So a bank's investment portfolio is almost never stocks, almost never. It's almost always some sort of treasury or some sort of piece of paper, some sort of debt instrument. Think a bond, treasury, something like that. What the bank CEO decided to do before 2022 happened is they bought primarily 10-year treasury notes paying 1.5% at that time. Now, when you go into 2022 and the Fed says, hey, we're going to raise rates, if you were to look back in history when the Fed says that they think they need to raise rates for fighting inflation purposes, they almost always have to raise rates way more than what they actually thought they were going to have to raise them. Now, you just had to look at history. So if you're running the bank, you could just say, hey, rates are going up. That's really bad for long duration bonds. Long duration, for those of you that might be catching the show for the first time, is just a fancy way of saying, how long is it going to take for my bond to mature? And if it takes 10 plus years and interest rates are going up to, let's say, 2% now, and you're holding as a 1.5% treasury note that's not going to mature for 10 years, why would I buy your 1.5% treasury note when I can go to the marketplace and get a 2%, right? You'd have to sell it to me at a loss.
Right.
I'm leading up to what actually happened here. So rates are going up way more than 1%, as we now know, in 2022. They went up the fastest that they've ever went up in human history. 450 basis points, 4.5%. 4.5 times what they thought they were going to have to raise rates to combat inflation. And now, 2022, rates are going up, right? The banks are losing their shirt. $620 billion was the paper loss that banks had on their balance sheet December of 2022. After Fed Chairman Powell's, let's call it debate with Congress in February, he probably increased that to 9% because they're talking about taking rates to 6%, during that conversation he had with Elizabeth Warren and everybody in Congress.
Yeah.
So it's probably close to like $900 billion worth of paper losses on these investment portfolios at banks because they're all buying these debt instruments. Unfortunately, some of them didn't think further on down the line and look at what history has to say about similar events. And that's why Silicon Valley Bank got in this pickle, because if you're lending to all these businesses and rates are going up, now you're not so cash flush because you don't want to lend out to another institution, another, let's say, tech startup in 2022 because your cost of capital went, way up. Went from 0 to a lot more.
Yeah.
Right? And because you're not lending and you've already made all these loans to all these other tech company businesses, well, they're spending cash like crazy. Again, they got a big burn rate. They're not all profitable yet. There's money coming in, but there's more money going out than it is coming in. So now as a bank manager, you're required to have a certain amount of cash from reserves.
Yeah.
Well, if you don't have those reserves and it's costing you a lot more to go borrow from the Fed, this is the first problem that Silicon Valley Bank had is they made an announcement to the whole world on Friday saying, hey, guys, we need to raise some capital. Well, the big issue with that is these days you can move money without having to walk into a branch. They lost 25% of their deposits in like 2 hours, billions of dollars. Yeah. So what does the bank CEO got to do? Well, now I got to start selling my bonds.
Yeah.
My bond portfolio. Remember I bought all those 10-year treasury notes?
Taking a loss.
Taking a 65% plus loss, right?
Man.
Because of the way the interest rates went up. So with this being said, I want to make this clear. I think that at least 5 to 10% of that bank's failure, Silicon Valley Bank's failure, is on the shoulders of the management team there, CEOs, and their executive team. I will make that very clear. I think that that's at least 5 to 10% completely on management.
That seems a little low too, though. Just because that's like just kind of you're in charge, it's your fault, that kind of thing,
Yeah, and the truth being, even though we stepped in over that weekend, last weekend, and kind of resolved that major concern, rightfully so, 16th largest bank, first bank failure since the great financial crisis of 2008. It is for sure in my mind a isolated event just due to the nature of their business model.
Yeah.
Right. However, I think 90% of the bank failure there is 100% Jerome Powell's fault, as well as what I call his Fed heads. Okay, so there's like 17, 19 different Fed heads. Not everybody has a vote. And we, the American public, we don't vote for any of these characters, by the way. We vote for Congress, we vote for the president, senators, all that stuff.
Right.
Congress and the president essentially appoint these people, right? They make a nomination, they have to vote on it, and that's how these people get put in this position. So the Fed is, in fact, a separate entity from the White House and Congress and the Supreme Court, legislative branches, all that sort of stuff. However, it's still highly politically involved because, obviously the president last year wanted to figure out a way to deal with inflation. The Fed's really the main tool for that. So they're obviously in conversation on a regular basis. The Fed and their Fed heads, they're all responsible for certain regions of the country in the United States banking system.
Right.
Their first mandate is financial stability. Back in 1913, Google this, for those of you that haven't taken this class yet, the Federal Reserve was created first and foremost to provide flexibility and financial stability for the United States. Now, they got all these regional Fed people, one of which is in California. I'm pretty sure that somebody was in charge of that, should have been able to say, hey, Silicon Valley Bank, you got a real dislocation between where rates are likely to go, and we're telling you they're going up.
Yeah.
And the way that you're structuring your bond portfolio. Nobody caught that. Actually, an accounting firm did an audit a couple weeks prior to their failure and gave them a clean bill of health. It's a completely different podcast, by the way.
Yeah.
So that happened. So that's what we were dealing with, even though we got this awesome inflation number. So we wake up on Wednesday, producer price index day. I'm excited, right? I'm jacked because we had a really good CPI print on Tuesday.
Yeah.
Market didn't do everything I wanted it to do, but I was like, oh, it's all due to this SVB failure. It's an isolated incident, yada, yada.
Yeah.
I'm jacked. Wednesday morning, got my cup of coffee. I'm up way before the news is coming out, and I'm just ready to go. PPI is coming out. I wake up, though, 6:30 in the morning, and instead of, getting prepared for this PPI number that's coming out at 8:30, the only thing that you saw was about this Credit Suisse problem. Now, let me take you a step back in history here, because this is a big part of our program.
Yeah.
Credit Suisse has always been a disaster, right? If you look at its history going back to like 1970 to now, it's been a flipping disaster from a bank. It's a penny stock, by the way. The stock is trading at $2.
Oof.
It is a penny stock. It's had all kinds of problems. And it's a Swiss bank. It's
not in America.
It's not headquartered here in America, and it's tiny. It's got its own problems. Okay, it's had terrible management forever. And we got the news here, just maybe an hour, not even an hour before we started this show today, that the Swiss National Bank is going to provide liquidity of up to $54 billion for this terribly run financial institution called Credit Suisse. And for whatever reason, that was the only thing that people wanted to talk about in the news. They didn't want to talk about how awesome this producer price index was and how much lower it came in than the actual numbers. It's unbelievable to me. So that in and of itself is a clear indication of fear selling.
Yeah.
100%. And on top of that, a company like Charles Schwab, brokerage company, that's where we custody our accounts for all of our clients. It acts like a bank in a lot of ways. But it also is, one of the largest brokerage companies on the planet. So they got thrown in that situation with all these other banks. So Charles Schwab stock lost almost half of its value in a couple days, literally. CEO of Charles Schwab, as well as the founding person, Charles Schwab himself, came out and said, "Hey, we're not like a bank. We have a lot of bank features to us, no doubt, but we're also a brokerage company. So when people sell their shares of stock, it doesn't leave Charles Schwab unless you push it somewhere else to some other financial institution. You start selling stock, that's the equivalent of me walking into a bank and making a deposit of cash.
Yeah.
You sell stock, cash goes into your money market position inside your portfolio.
Right, which they're doing stuff with unless you do stuff with.
And in addition to that, 80% of their money, the cash that's in Charles Schwab, is backed by FDIC insurance and so forth. So I took it upon myself for some newer accounts to go ahead and take advantage of this. And bought some shares of Charles Schwab for a few newer accounts that had some cash available, so I didn't have to sell something else as everything was going down. And bought it at a low price. It popped the very next day, and within 24 hours, I got out of the position at a pretty nice profit for those clients in those accounts. That I give you that example, not to pat myself on the back. I give you that example because it's strictly a good example of what fear selling looks like.
Mm-hmm.
Why did that get thrown in there with all these other regional banks? Charles Schwab could swallow up all kinds of regional banks, right, if it really wanted to. That's just how large it is. So that took away all the awesome inflation news. Again, we should be popping champagne right now instead of talking about all this stuff.
It is March Madness.
What was the major risk coming into this year? It was inflation, right? Whether or not inflation is coming down like we saw in October, November, December, or is it going to start to rear its ugly head again and continue to rise, which in fact is not what we're seeing here. That was the major risk. Now the risk is, well, the Fed broke something finally. If they keep raising rates, what else are they going to break?
Right.
And that's what I want to spend a little bit of time talking about here. So let's take a little trip back into memory lane. And by the way, the market's doing great, specifically technology. Technology is up over 2% for the week over the last 5 days. It's still up double digits here for the year. S&P is down for the week. It's barely hanging on to positive territory, and the Dow is still taking it on the chin. No doubt about that. Small caps are taking it on the chin the worst here at the moment with all the news. All right, let's go back in history, 1994. So 1994 is a very, very eerily similar event as what we're going through right now. So I'm getting all the information pulled back up here. So in 1994, we increased rates 6 times, and we got up to 6%. And this is all the way through November of 1994. We kept increasing rates. Then we get to February 1995. February 1995, we finally increased rates 50 basis points for the last time. So that was the 7th time that they increased rates. Now, what was the performance during those years? As I make this a little easier for myself to read. So if you go back to 1994, we had a meager positive 1.32% in the S&P 500. So again, we raised rates 6-7 times in 1994. Very, very similar to what we saw in 1992 or 2022, right, last year. And last year, of course, we were down 20% in the S&P 500. So 2022 S&P is down 20%. 1994, when we raised rates all those many times, we had a positive 1.32%. So that's a little bit different. 1995, again, we raised rates 50 basis points in February. I think the Fed is likely to increase interest rates. It's a coin flip right now. If you look at futures market, Fed funds futures, it's like a 50-50 chance that they'll raise rates on March 22nd next week by 25 basis points. I'm going to give you my opinion here in a second. I think most people probably know what that is by now if they've been following the show. All right, 1994, we increased rates a bunch. Market was barely positive. We get to February 95, we increase rates 50 basis points, and by July, we start cutting rates. We cut rates 3 more times, 1995. Stock market performance in 1995 was 37.5% positive. 96, almost 23% positive. 97, 33% positive. 98, 28.5% positive. And 1999, 21% positive.
Wow.
So the future's looking pretty good here as we get to the point where the Fed is no longer hiking rates. They either pause or start to begin to cut rates. So that's what history has to say. As painful it was in 94 to live through all that, and in returns leading up to 1994 weren't all that great either. They were okay relative to what history would have to say. So that's why this is looking very similar to 1994 in my view. Inflation's coming down. I think we've hit max rate hikes, most likely, coming up here. We're either going to get one more hike next week, or we're going to have a pause. Now, what's really ticking me off as we watch CNBC yesterday, or this morning, I should say, you got like Harvard, economic professors coming out and saying, hey, if we don't increase rates by 25 basis points in the next meeting on the 22nd of March, that's going to signal to the market that the Fed's more fearful of, whatever, breaking the economy, breaking the banking system, whatever. I'm like,
that's a good thing.
That's a good thing, bro. Like, how did you get this job at Harvard? Right? I'm sure you're a smart dude, but let's put a little bit of logic into this entire situation here.
Right. It's like a doctor saying, hey, if I don't stop this treatment, I'm going to break your leg, but I don't want you to think I'm weak and scared of doing that, so I'm going to keep this treatment up.
Right. They're looking at their credibility. I'm like, the hell with your credibility, man. I don't wake up every day to do a job for credibility purposes. Right? I don't make decisions based on credibility. If you do your job the right way over a long period of time,
you get it.
You do get it. That's how you earn credibility. So I don't give a damn about the Federal Reserve's credibility in this situation. They've been wrong the whole time. They were late to raise rates. Then they raised them faster than they ever have in human history, and they finally broke something. They've said this word data dependency. We did a whole podcast on this.
Several. Yeah.
I don't know how many times months ago. Go back and watch it. Go to shepherdwm.com. It'll take you right to anything you want to go to.
Right. YouTube page. It's on there archived.
I don't know how many times they've used the word data dependency. I don't even know what it means anymore. If they come in on March 22nd and say, hey, we need to raise rates again, you got all the cover in the world. You could say, hey, look at the CPI, the PPI prints, right? Inflation is in fact falling. The only reason why the CPI print wasn't more in our favor, meaning lower than what analysts had expected, is because 34% of the index that they use to calculate CPI is housing. It's still showing a positive number. You take housing out of the equation or throw in a real housing number, like Professor Siegel did, you get negative inflation, or you get inflation that's falling to 2% or right at 2% if you take out housing right now.
Yeah.
That is the Fed's long-term target. You can point to that. You can point to the fact that you guys broke something and say, hey, I'm going to pause and look around for a little bit because we all understand we've only been increasing rates for 1 year. There's a minimum 12-month lag effect before all this stuff starts to show up in other industries in the economy. Some of it's going to take 18 months.
Especially like housing, right? It takes a long time.
You frame it like that, this is the truth, first of all. But you're not hiding anything. That is the truth. And this is my big one here. So I gave you guys a history lesson of 1994. I think we're going to repeat that. I think we might have one more rate hike. It would be stupid because it's going to be the very first thing that they cut, probably in May, June, something like that. It would do nothing for the economy in the moment. You increase rates 25 bips on March 22nd, in the moment, does nothing for the economy. Stock market will probably take it in stride because it's already pricing in a 50-50 chance of that happening.
Yeah.
It was like, 80% chance of a 50 basis point hike like 2 weeks ago. So for all those that know exactly what interest rates are going to do and how they're going to affect things, you're just flipping wrong. It's like trying to predict the weather. Okay. So history lesson, bank failures, awesome inflation data. Good news is I feel really terrible for everybody at Silicon Valley that's an employee there, customer there, all the stress that you all went through. I feel bad about the entire situation. However, it happened, and it is a isolated event. Credit Suisse, they've been terrible forever. So that meant nothing to me.
Not in
almost.
America, not tied to our interest rates.
Yeah, meant almost nothing to me when I saw that news.
Yeah.
Although everybody seemed to care about it. So we went through history. Again, I think we're going to see a repeat of that. I don't know if we're going to have 33%, but I have been calling for double-digit returns all year in 2023 because of a lot of things that we've seen from history. Now, I'm going to say this with a ton of humility because it's true, and I think you would back me up on this, Ez. I am not a politically motivated person in any way, shape, or form.
I know that to be true about you.
And I have to pay attention to all of these things, right? So I watched this, hours of, let's call it a tough conversation that Powell had.
A heart-to-heart.
Powell had to have with all these Congress people, including Elizabeth Warren. So I think anybody that knows me knows that I just don't agree with I can't think of anything off the top of my head anyway that she's, stood her ground on, that I was like, yeah, that makes total sense to me. Like, I get that. I'm behind that. I usually never agree with almost everything that she has to say. She is 100% right, though, with what's going on here with the Federal Reserve. I personally think, going back to my statement at the beginning here, I think about 5 to 10% of that bank's failure is on the shoulders of management. 90% of that or more is on Fed Chairman Jerome Powell and his Fed heads. I think that they should be brought in front of the court and be subpoenaed and tried, right? You have the finger on, you are the finger and the pulse, by the way.
Yeah.
If you're the Fed, you should have been able to see this.
You're the captain of the whole Megillah.
So she's 100% right with all these hard questions that she was asking Fed Chair, Jerome Powell. Because in the history of the Fed, their own target projections is they wanted to take unemployment from, at the time, 3.4% to 4.5%. They thought in order to contain inflation, they needed people to lose their jobs. Well, guess what? You got some of that with this bank failure. And you're seeing it across tech as well. Tech's laying off people. Meta, Facebook, letting go of another 10,000 people, closing 5,000 opening jobs. You're going to see more layoffs in the financial sector for sure as it relates to everything that just happened here. And you might see in a couple other sectors as well. However, here's the data, and she's 100% right. For the last 75 years of the history of the market and the Fed, if the Fed were to see the unemployment rate rise by more than 1% in a calendar year, which is what they're talking about doing right now, they've always caused a recession 100% of the time, right? And if that were to happen, at least 2 million people would lose their jobs if you got to 4.5% unemployment rate. I don't know how that's going to be super helpful for a lot of different reasons. We should never be rooting for people to lose their jobs. But her big point is the Fed has never been able to stop it, right? If you get unemployment to rise by more than 1%, they've never been able to stop it at that point.
Right. You can't just say, hey, we're going to cap it here.
Right.
Everything's good.
So it ends up being more like 3.5 million people losing their jobs.
Yeah.
And then you want to start to cut rates. You're going to do all that just to cut rates. What I loved what she said at the end is, quote, you cling to the idea that there's only one solution, laying off millions of workers. We need a Fed that will fight for families. And if you're not going to lead that charge, we need somebody with the Fed who will.
Yeah, 100%. I mean, you've said on the podcast several times, the thing that prevented last year from being a on-paper textbook recession
100%.
was that people had jobs.
Yeah.
And they still had income. You phrase it as money in their pocket. And you're not saying like everybody's going out and buying PlayStations. You just mean that, people weren't forced into the streets because they didn't have a job, right? They could still pay mostly to pay their bills.
Right.
So if we avoided it with that, like, why is that not an asset?
It is.
In the Fed's eyes, though. You know what I'm saying? Like, why are they rooting for the opposite?
Well, what their thing was like wage inflation. They were like, oh, man, people are essentially going to continue to cause inflation because now they're getting paid more money. That was their argument in a nutshell, which was stupid because inflation at its peak was 9%. The average worker, now I get it, if you switch jobs, the statistic was you got about a 15% on average raise.
Yeah. Also, minimum wage is the same still.
Yeah.
So they didn't get a raise.
But the dealio is that the average, American worker, which is the bulk of the economy, by the way, is not like this entire economy isn't a bunch of software engineers. Right? If you were a software engineer, you got a 15% bump because you went from Apple to Microsoft or whatever it was.
Yeah, and you're saying this is everybody's circumstance combined into an average. This isn't the polarity of either side. This is just the
5 to 7.
Okay,
was the average increase in wages.
Uh-huh.
That's, in my math, at least 4% below what inflation's peak was.
Yeah, I mean, if I took 5 out of 9, I'd have 4 left over.
I don't know where everybody went to school, but that's the math that I came out with. So, and we're in Kentucky here, so if we're right, then it's got to be right.
Yeah, we're not exactly known for our bastions of education.
100%. So I just disagree with that all the time, the entire time that they were talking about that.
Yeah,
again,
you have.
Go check out prior podcasts for that. But that just wasn't true, and that's not what we're seeing in the data. Actually, the last inflation report that we got, we saw wages slowing.
Yeah.
Right, to a more sustainable pace. So you can't even point to that and say, yeah, this is the reason why we got to keep jacking up rates because this is sticky and it's going to continue to cause inflation. It's not. And it's showing up in the data as such. So this guy, Powell, on March 2nd is going to have, I don't know, it's what, about 7 billion people on the planet? I'd say at least half of the at least half of the planet has access to either a phone or the internet or a TV, television of some kind, or worst case scenario, a
radio or something.
Yeah, something. Yeah. They will be paying attention to every word that he has to say because some people, again, are still asking for rates to go up. I don't know why. You're going to have them cut in May, right? It's what's going to happen. You will see rates being cut, and you're actually seeing that priced into the market now. That's the reason why the 2-year went from over 5 to under 4 in like a couple freaking days.
Yeah.
Right? It's all about inflation. This is not a bank contagion problem. This is not 2008 where you got a bunch of greedy bankers sending out loans to people because rates are basically, super low. Mm-hmm. And, you're allowing, people that run a bar in Nashville to have 3 houses, right? This isn't 2008. It's not.
Right.
It is not that.
That was some cheap rent, though.
It was party on until it wasn't.
Yeah.
No doubt about that. So we've learned a lot from history, and certainly history has been shown to repeat itself. As Warren Buffett famously said, the one thing we know for sure about human beings is they do not learn from history. So here's what I think the Fed should do. Right, I'm going to try to put a nice little bow on this. If you got any questions, I got my phone hooked up to the audio system here. You can text me or call me, 513-630-2664. We'll answer those questions live here on the program.
And I just want to jump in. Anybody who sees this afterwards on our archive YouTube page, if you leave a comment, Joshua will also respond and answer your question.
Like, subscribe to it. That way you get a little notification push every time we drop one of these. So here's what I think Jerome Powell should do. First of all, I would apologize to everyone first and foremost.
Yeah, that ain't happening.
I know. And by the way, I will gladly receive a fee for writing your speech here next week.
Chairman Powell,
you can hit me up anytime, 513-630-2664. I'll charge a fee.
Also, if you need a hype man prior to that, I'll go in front of Congress right now.
There you go. That would be worth watching.
I'll go in front of Congress right now and filibuster that until you're ready to talk next week. Watch me.
The truth is, if I'm the president, I would have already made the phone call and say, hey, the hell with the meeting on March 22nd. Today at 1:00, you're going to be in front of the whole world.
Well, that's the thing. I mean, basically the Fed chairman's just a rogue, right? He's not accountable to anybody. No one can tell this dude what to do.
Well, he got appointed, and that also means they can take appointments away too.
You're right. There is that little bit of accountability.
So if I'm in the White House, I'm like, the hell with March 22nd. You're going on right now. I mean, if you think about it this way, they saved Silicon Valley. Well, saved is a strong word. They provided stability in the financial system with how they are backing depositors.
Yeah,
they're not saving the executives. They're not saving the bank. If bank is operating for now, somebody's probably going to buy the assets.
Yeah.
Okay. You got the news on Friday. Silicon Valley Bank's about to blow up. Over the weekend, our Treasury Secretary, Janet Yellen, and Jerome Powell solved the problem. If you can do that over a weekend and you get this news about Credit Suisse on Wednesday.
Zoom. Yeah,
Dude,
hop on there.
Wednesday, Powell, I don't know what you're doing in the afternoon. Clear it out of your calendar, but you're going on TV and you're going to make this final statement here.
Yeah.
That, hey, here's all you got to say. First of all, I apologize. We have a blunt instrument tool here to fight inflation, which is increasing interest rates. Our mandate, going back to 1913, is first and foremost to provide financial stability for economics here in the United States, right? And now we've had an issue over the weekend that we've had to resolve very quickly in order to provide, the American depositor with the confidence that, your deposits are safe.
Yeah.
Right. So they even backed up more than the $250 insurance for FDIC insurance, right, at the bank. So people had, millions of dollars at the bank
Covering it.
Right.
Yeah.
That was the right thing to do, by the way. Because if we lose confidence in our financial system, I mean, we are the world currency. We are the largest economy on the planet. If you don't have certainty in this country with our financial system, I mean, that's the whole thing the U.S. dollar is backed on.
Yeah, our sovereignty.
You have anarchy. It's what is the movie Purge?
Oh, yeah.
It's going to be that, but not one day a year. It's going to be like all the time. That's how important it was. So I agree with what happened. But if you can do that, you could have came out on yesterday afternoon, and said the following. I'm very sorry that what happened at Silicon Valley Bank. We have a blunt instrument tool here to fight inflation, and that's increasing interest rates. And we've said we were going to be data dependent, and we're going to take us to a point to where we're restrictive. Obviously, based on the last CPI and PPI data that we got this week, and due to the fact that unemployment did tick up a little bit from the prior month. And now we have this financial shock from Silicon Valley Bank and Credit Suisse. With all that being said, I think it's a really good idea that we kind of allow the lag effect that we know happens here with increasing interest rates, specifically as much as we have, to take effect until our next meeting. We will truly be data dependent. We will not decrease rates for now. If inflation continues to be stubbornly persistent, then yeah, we might have to step back in and increase rates again. What is wrong with that? The hell with your credibility?
Yeah.
It's been screwed from the beginning anyway. You were wrong the first time.
I'm only laughing because it's true. It's not funny. It's people's lives,
Yes, it's our life. So I got to do a dance, every quarter and talk about, what the performance was, why it was, where we're going, why are we investing this way, yada, yada. If I am not data dependent, I am fired immediately.
Right.
I haven't lost a client at all due to the fact that we are giving this type of data and information on a regular and frequent basis, weekly, to be exact. Might not do a podcast every week, but we're definitely getting information out to clients on a very consistent basis, right? Because if they don't understand what I'm thinking and why and what the game plan is, then it's a complete waste of everybody's time and money and energy to hire somebody like myself, right? This is the time where people like myself truly show value, and that is exactly what we've been able to do here for our customers. Thankfully, technology has held up extremely well in the face of all of this. Without any question, that's our biggest sector. Overweight, we are still in that camp over the next 8 weeks. If Jerome Powell comes out and actually tells the truth about what's going on here, I think we're going to have a really nice, stretch of market performance leading all the way through most likely April. And then in May, we'll kind of look around and see what happens then, because then we start to get a little closer to summertime. Seasonality start to play a factor in, market performance and so forth. So that is what I think they should do on March. Matter of fact, they should have did that yesterday. They could do it anytime. You could do it today, tomorrow, St. Patty's Day. You can drink a green beer for all I care. But these guys should be potentially criminally charged because they're the primary culprit for what exactly happened with Silicon Valley Bank, and they could have prevented it. And the fact that you got regulators after the fact, pouring gasoline on the fire, I mean, it's just stupid. It's just really, really stupid about the way that they're looking at this entire situation here. So that's my feelings and thoughts on it. And as I don't think we got anybody to hit up the line here or not, but we basically went over the good news, all the bad news, and what history has to say about it. And of course, I actually had to admit I agree with Elizabeth Warren. That was a big statement today, at least on one topic.
That's okay. I mean, she's right. She's right.
Yeah.
That's all,
I got to call a spade when I see it, right?
Yeah, there's nothing wrong with that.
And then, of course, we got next week's major meeting on March 22nd, 2 o'clock p.m. Eastern Standard Time. Yeah, so that's what's going to happen next week. That's
March 22nd. Oh, wow. Yeah, that's soon.
Very soon.
Next Wednesday.
Yeah, so that's everything that we had for today's show. I think we covered everything that we wanted to cover here today. So don't forget to check us out, shepherdwm.com. All the prior podcasts that we've done right there on the website. You can check out a bunch of information about the firm, myself, our president, John Ashcroft. And we got a lot of really cool, exciting news. We got an app coming out. It's actually live on Android and Google devices. We're waiting on iOS or the Apple device to basically do their thing with our app. And once that's live, we'll have a lot of really cool things to share with everybody as well. We try to do these shows about every 2 weeks. And we got a lot that we'll certainly need to talk about with everybody over the next 2 weeks. But you can always send us your questions ahead of the show, 513-630-2664. You can like us, follow us on Facebook. I'm also on LinkedIn. And we'll look forward to doing this again in about 2 weeks, Az.
Yeah, I'm stoked for it. We'll probably have some info for the people next week as well with that major announcement. So
absolutely. And we're getting ready to do a blog as well. So if you go to shepherdwm.com, I'm going to do a weekly blog post. I'm going to try to get in there at least every Friday. And the reason for that, just kind of give you a quick little wrap up about what's going on in the week, because we also like to do a Friday happy hour show. We hop on here, we do 10, 15 minutes of a weekly recap. Again, we still try to provide historical precedents and talk about, what's coming down the economic front over the upcoming weeks. So really appreciate everybody's time. It was a lot of fun to get this
great.
All off my mind and shoulders here.
I hope you feel a little lighter.
Yeah, I hope everybody got something out of it. I'm still waiting for Jerome Powell to, it might be him right now. Jerome Powell maybe hit me up here for writing a copyright.
Did he say something about the hype man?
I'll get back to you on this.
Yeah, we'll do that off camera.
Yeah. Well, I appreciate everybody's time. Hope you got something out of it, and we look forward to doing this again in a couple weeks. Have a great rest of your day.